Now, as I mentioned, markets staging a comeback today thanks to cooler inflation data. NASDAQ's the big standout, pushed higher by AI and Mag 7 and, of course, Micron. Is this a sign we're going to see a rotation back into these names, or have investors moved on? Joining me now are Keith Lerner from Truist Wealth and Warren Pies from 314 Research. Guys, welcome. Warren, how good was this inflation report versus what some of the fears were out there? Disinflation, perhaps?
Yeah, thanks for having me, John. I think the data quality was there were left a little bit to be desired, but the ultimate net read is positive for the markets. And I think it's, we've had this blackout of data during the government shutdown, and we're finally getting a data dump, some employment data this week, and now CPI data. And it kind of confirms like something we talked about if you go back 12 months ago when I was on with you, is that we looked for disinflation to come through three broad vectors in this economy: oil, labor, and shelter. And I think the shelter data in this CPI report was especially encouraging. And it shows that I think that story is definitely evolving and will be with us for the first part of the year. So positive, yes.
Okay, zooming out to the market implications, Keith, since September, the NASDAQ's kind of been bobbing between 22K, 24K. We're sort of in the middle there. S&P has been stuck between 6,500, 6,900. We're a little bit higher than the middle. Where are we in the cycle? Why do you think we're sort of bobbing around?
Well, I think if you zoom out for a second, the big picture is, we had one of the biggest 6-month returns for the market we've seen in history. And if we think about the technology sector, you were up about 70% off the low. So I think what happened is that you had expectations become elevated and you've been churning, rotating to kind of cool that off. But I think in some ways, markets can correct in time or price. We're seeing a little bit of both. So I think ultimately it's a good thing. And as we look into next year, our base case is that we have a modest uptick in the overall economy. When we look historically at bull markets that have turned 3, there's been 7 of them since 1950. All of them saw gains the following year. And then lastly, more recently, we saw the Fed once again cut rates when the market was around an all-time high. Historically, when you look forward 12 months, the market's been up about 90% of the time. So to put that all together, John, I think we're going through a little bit of a rest, but I think ultimately the underlying trend still deserves the benefit of the doubt.
Interesting. Warren, you also think the S&P 500 will rise more than 10% from where we are here by the end of next year?
Yeah, our target is 78.50. I think that we're going to have the strongest earnings growth next year that we've seen since 2021. I think the most encouraging thing when we dive into what's going on in the markets right now is if you look at Q4 estimates. So the quarter we're in right now, which will be reported really generally around mid-January, we're seeing those estimates continue to levitate. Generally, this time of the year, their companies are talking them down. So we've only seen this a handful of years in the last 25 years or so, and it's the most we've seen since 2021. So I think it portends a very strong earnings year. And contrary to the popular opinion out there, I just don't see a lot of multiple compression in this market. I think we get modest multiple expansion because margins are expected to be up by 90 basis points next year. The Fed is cutting. I'd challenge anyone to find me a historical year where multiples come in while margins rise that much and the Fed's cutting. Just generally doesn't happen.